16 now. If you want to adjust your mortgage, buy a home, or open a business, the Fed's got your back. Yesterday, the nation's top bankers decided to keep interest rates near zero for now. Could this cause a problem in the long run, though? Joe Krier, president of Krier Wealth Management, is here to talk about that and to discuss the increasingly optimistic statements by the Federal Reserve. Hey, Joe, how are you?
I'm good.
So no surprise, really, in your opinion, that they kept the interest rate near zero. What are they trying to do by keeping it so low?
Yeah, they're trying to make it easier, as you mentioned in your opening there, for individuals to borrow money, perhaps refinance a home, which I did about 6 weeks ago, for businesses to borrow money to maybe build new plants and things. And it's a slow process. We're at the bottom of an economic cycle, and they've got to do this. We call this an accommodative money policy when they make it easy for people to borrow. The prime interest rate is at 3.25%.
So what they're trying to do is basically stimulate things, keep stimulating things and trying to.
Yes, one of their statements that Bernanke mentioned last week was the recession was likely over. And what he keeps referring to is the fact that things are still falling, they're just falling at a slower pace. We have to kind of take this with a grain of salt.
Okay, so what's the downside to all of this? And that's inflation, right? And experts have been warning about inflation for almost a year now.
Yeah.
And maybe longer.
The two main objectives of the Fed when they were established back in the 30s was to maintain employment at full levels and to control inflation. And they've been worried a little bit over the last few months that we might get into something worse than inflation, and that is deflation, where we have a declining economy and falling prices. They feel like they've averted that problem, and now they're sitting here on these low interest rates. If things start heating up too quickly, then what they're going to have to do is raise interest rates more rapidly than they want to in order to slow it down. This is kind of the cat and mouse game that the Fed always plays, and the problem is that when you raise interest rates, it usually takes 6 months for that increase to take effect. So inflation is like a fire. If it gets going, you got to put it out before it gets out of control.
But obviously they don't feel like this is a problem as of yet.
They think that it's going to be subdued for some time. I mean, what they're seeing here is that consumers are having a hard time borrowing money. Even though interest rates are low, the banks are very cautious about lending because, let's face it, they learned their lesson over what's happened in the last couple of years, and they still have some problem loans on the books. So consumers can't get money, unemployment is still fairly high, and all these things hurt sentiment so that consumers aren't out there really spending money at all right now.
And yet the market seems to be going. Who can explain that?
Yeah, the market is taking off, and people say that the investment markets tend to be a sort of a forecast of what's to come in the economy. If that's true, then we've got a recovery right around the corner. I'm not so excited. I think this market's a little bit ahead of itself right here.
All right, so let's talk about what the Fed said for the month of September. Here are the quotes. Economic activity is picked up following its severe downturn. Inflation will remain subdued for some time, and consumers are hampered by tight credit, low wage increases, and unemployment. These all seem to be true, right?
Yeah, and this is kind of an evolution of statements. Back in June, they were talking a lot more negative. So, we're just talking about 3 months here. The progression is towards more positive statements, and it's thought that the Federal Reserve has more data than any of us do to look at. They're getting the real behind-the-scenes look. So if they're talking more positive, perhaps things are starting to turn the corner.
All right, now let's look at September Fed actions, what they've done so far.
Yeah, the economic upgrade is mainly in their verbiage, where they are saying, hey, things look better, and they're trying to get consumers to be a little more confident. But the big thing they did was they extended their mortgage repurchase program. And what that refers to is that the Feds are buying mortgages, like I mentioned, my refinance about 6 weeks ago. Well, that was sold to Fannie Mae and bought by the federal government within a month.
And I just read this morning that they're going to extend this to March to buy these so-called toxic assets. It was supposed to be done by the end of the year.
Yeah.
Now they've extended it to March. What does that mean?
And that's actually a good thing. It sort of speaks to being an exit strategy, because what they're doing is they're trying to provide liquidity to the market by buying these mortgages. And they had committed $1.2 trillion or something like that. They're not adding new money. They're just stretching out the period that they're buying the mortgages back. And that's a good thing, because rather than blowing another $600 billion this year, they're stretching it out and hopefully letting the market take care of this itself. So in a way, what they're doing is saying, we're not going to help as much as we had anticipated because we don't have to. the market is doing its own thing.
Does it sometimes feel like they're just throwing meat into a sausage grinder and seeing what comes out on the other end?
It's a major experiment. They've never been faced with anything like this before. So it is a lot of things that, yes, they started throwing at a year ago is when they introduced this mortgage repurchase program. Now they're slowly backing away.
All right. Joe Krier, I don't know how you sleep at night trying to keep track of all this. Joe Krier is president of Krier Wealth Management, joining us to talk about the Fed and what it's doing in the month of September. Thank you very much.
Welcome.